Hello traders and welcome to the channel once again. Today we are going to talk about one of the important concepts when it comes to what trading. Now within the week, someone asked me an interesting question concerning or about my take when it comes to what setting break even. Because normally we set or you set break even on your trade and then market comes back and what takes you out. However, break even is not what a bad trading what concept, but you need to understand how you are using it. So this particular concept is going to what help you understand some of the concept or some things that you need to know. All right, when it comes to setting your break even and other stuff. So if you've ever noticed that normally or mostly when price what creates strong move in the market, it's mostly pulls back to specific zone before market continues towards to the intended what direction. So most traders see that what a pullback or it is called a pullback on the market. But however, in smart money or smart money traders also things of it what in a different way, and that is what they call what a return to origin or a return to what order block or any key level. And once you understand this particular concept, you stop to changing price and start entering trades where institutions actually position what themselves. So in this particular video, I'll be what explaining what an RTO means to you, why it happens, how to identify it, and how you can use it for what highly probability what trade. So make sure that you watch this particular video to the very end of it. So let's move on to the lesson for the day. So when we talk about what an RTO, what an RTO means is that it is, or the full meaning is called a return to what origin. Some people also call it what a return to order block, but anyway you call it, the meaning is not what. It doesn't matter. The concept is what is necessary. So mostly when the price what creates strong moves, price creates what strong impulsive move. What market does is that it returns to specific what areas. All right, market returns to specific areas in the market before the actual move what or the next move will what return. All right, so the reason why markets does this is that mostly institutions what create move to attract what traders to join, and also they leave what positions what behind. All right, they leave others what behind. So they normally what or they normally create pullbacks in the market to mitigate the zones so that before market will what expand again. So that is why price often what pulls back in the market. In the later part of this particular video, I'll be showing you the biggest mistake that traders make when trading what RTO or when trying to what find zones in the market, and why most of them get what stop out. So keep watching this particular video towards the very end. So now let's move on to another important concept when it comes to what's trading RTO. So why does price normally what does or price normally retraces back? Now prices retraces back due to three particular what reasons. The first one that we are going to talk about is what liquidities. So normally reasons why price what pulls back is to what grab liquidity before our market would move. So let's say we have what a move like this. We have liquidity being created, a pullback. What price would that price normally does is that market is just going to pull back to grab liquidity from this particular zone before we see the next what expansion on the market. So one reason why markets pulls back or returns to what key levels or origin is that price market comes down to what to take what liquidity. The next reason that we are going to talk about, or the next reason why that price mostly pullbacks, is also to mitigate what orders, and like I said, one thing that institutions does is that or I think of it that institutions do not enter all positions what at once. What institution does is that what they leaves what orders behind. So normally when market is moving, they retraces or price retraces backwards to specific what areas in the market what to trigger areas where orders have been what been left, and that is where order blocks and then fair value gaps and all those concepts what come back. So when market is moving, or when you notice that market what moves, and then there are what zones like order blocks, fair value gaps, and others are being what left behind, what the market is going to do is that market is going to what retrace back to what to the zone before another move or another expansion is going to what happen. So if you are in a trade, or when you are in a trade and then you notice or market price that what's leaving zones like this behind, what people normally do is that sometimes when they see the pullback, beginners normally what start panicking. All right, start panicking, and this is where sometimes when you get to understand this concept, your patience in holding trades becomes what more. So there are mostly questions like how do you become what patient? How are you able to what hold trade? Because when you understand that, oh, okay, this area is this particular area is what an RTO zone where orders are being left. So let's say you have what your entry. Let's say you have your entry at this particular point, and then you saw that market has what pulled back almost to what your entry level. You wouldn't panic, or you wouldn't what close your trade out of fear because you are losing profit back to what to the market, because you understand that there are orders that are being left behind, and that is the reason why institution, or that is the reason why price is what returning back to that particular level before it moves. So when it comes to patience, this particular concept, if you understand it, it helps you to be what more patient with what with your trade. Now the next one that we will talk about, or the next reason why markets normally what return back to specific zone, is due to insufficiency. So when we talk about what insufficiency in the market, when market creates, or normally when market creates what aggressive what moves, or when we see heavy what expansion, huge expansions in the market, what the market does is that it creates what we call insufficiency or imbalances in the market. So what price needs to do, or what price does, is that let's say all these areas over here are imbalanced what zones, price is going to what return to create what sufficiency. Institutions will return to create what sufficiency before they are going to what move the market to what to the original direction. So if you've entered a trade at maybe a specific zone, for example, if you entered your trade and you have what the insufficiency, if let's say you enter your trade from a level like this, and then you entered your trade from a level what like this is your entry level, and all these areas are what insufficiency zones, the probability that you are going to hit break even on your trade is what very, very high. Or if you do not close, this is where sometimes beginners make what mistake, because they are expecting that market is going to what return, so they don't even set what a break even. But you find yourself that market keeps what going downwards, and then you are being what either taken out, or you close your trade in losses out of fear. All right, so these are the three reasons why that market normally returns to what zones, or returns to the origin of what of trade. Now let's move on to another aspect of it. So the next thing that we are going to be talking about is how you can identify RTO zones in the market. And as we discussed earlier on the reasons why price pullback, first we are going to, or the first step that you can use to identify RTO is what to look for liquidity zones in the market. So liquidity zones, equal highs, equal lows, previous day high, previous days what lows. Normally price pulls back to come and take this particular zones in the market. So for instance, if we are having a move like this and we have our equal lows being created like this and price pullbacks, the probability that this market will come down to sweep the equal lows before going up. So this becomes our equal low zones before market will move. It's very probable. So then if we spot or if we identify any other block around this particular point, then that becomes your RTO zone that market returns to. It is not always that you are going to find other block. It could be a fair value gap. It could be a support and resistance zone around that particular level. That is why I say that RTO means an area or a return to a return to origin. All right. So if you want to be able to spot RTO zones, you need to, or the first step that you need to take note of is you look for liquidity. And also, as I said, when it comes to liquidity, we have the equal highs and equal low, previous day high, the previous day low, and other liquidity concept as well. The next step that you can use to spot your RTO zones is looking for areas in the market where orders can be found. So order blocks, fair value gaps, and all this key level. Normally, when price is moving, price normally retraces to that particular zones, because that is where, or those are the areas where orders are normally left behind. So if market creates a strong impulsive move or a strong displacement, leaving insufficiency, leaving orders or creating order blocks within the zones or within the swing leg, normally price is going to return to that particular point before market is going to move. So you just look out for orders around that particular zone. So you just position yourself at that particular point so that when market comes to that particular zone, you will be able to take your trade from, or you'll be able to trade from that particular zone, because that is where institutions are likely to be trading from. And then the next one that we are going to talk about is the insufficiency. So when market create insufficiency is being caused by displacement move or strong move from that particular. So if you have things like a strong engulfing candles and other stuff from a zone, there is a probability that market will have to return to fill that particular zone before market moves. So these are the three steps or three steps that you can use to identify RTO zones in the market. Now, here is the most part that most traders would normally get it wrong. First mistake that traders normally does is that entering every pullback, they enter every pullback. Now, not every pullback that you see on the market are RTO zones. That is why I've given you these three steps or these three concepts, so that you can use it or you can follow it to trade. And also, another mistake that traders normally do is that they ignore liquidity is. All right, market is being engineered by liquidity. Price goes after liquidity. So always you need to pay attention to liquidity. And the last mistake that traders do is that they ignore market structure. So you need to pay attention to the market structure. So if we are looking at a bullish market like this, you should be expecting that market is normally going to be retracing or coming down to bullish RTO levels in the market. So you don't need to be going against the direction of the market. So now let's go onto the chart and let's see if we can spot any form of RTO zones. So if we look at this particular trade over here, if we look at this particular trade over here, so we had this key level, this particular zone over here, this order block that's we have this order block at this particular level. Now you can see that we had market what having this strong what impulsive move all the way towards to the upside. So maybe you were expecting market to continue, or let's say you took this particular trade expecting this market to what to go to this particular level, but then market then started returning back to this particular zone. So at this particular point, if we are to what break down or analyze it, first you can see that market created what liquidity around this particular what equal liquidity, equal lows liquidity was around this particular zone. Now this was a displacement that happened, leaving what or causing an imbalance or insufficiency what in the market. So the market has to what create sufficiency. So markets created this what reversal move to what to fill this imbalance being what created, and also we had this what order block being left behind. So you see that these are the reasons, or these are the reasons why price normally what pulls back to the market. And once market was spotted, so once you are able to identify some of these concepts, you are able to what determine, or you are able to what know where you are supposed to what enter your trade, or where you are supposed to what enter your trade from. So once you are able to identify all these things, the return then becomes what your opportunity for another entry. And also when you want to set your break evens, you know where to what to set your break even. If you get to understand this particular concept, it is going to help you to be more patient with what with your trade, avoid unnecessary fear when market is what pulling back, because you understand that market is coming to what a particular zone, and also how to what exit your trade. So if this particular video helps you to understand reasons why market return to any origin or any level in the market, kindly ensure that you subscribe to what the channel, so that anytime that we drop any video, you are going to what get a notification so that you can watch it. Thank you for watching this particular lesson, and see you in the next video.